The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe and happy Friday, everyone. I'm Karen Cho with Juliana Tattelbaum in Paris. These are your headlines. President Trump hits the pharma sector with tariffs of up to 100%, sending names across the sector lower in Asia, with the EU set to avoid direct impact under its trade deal with the US. The US economy expands by more than previously expected in the second quarter, revised data shows, notching the fastest pace of growth in almost 2 years. President Trump signs an executive order to keep TikTok alive in the US, valuing its operations in the country at $14 billion, but Beijing is silent on the deal. Pharma, biotech and healthcare stocks across Asia are in the red this morning after President Trump announced fresh tariffs on branded or patented drugs entering the United States. A duty of 100% will be imposed on those pharma imports starting on the 1st of October. The US leader said an exemption will be granted if companies are building drug manufacturing plants in the country, which includes companies that have already broken ground on projects. Trump also unveiled a 25% levy on heavy truck imports and tariffs ranging between 30 and 50% on furniture and kitchen cabinets. The US-EU trade deal should see European pharma companies insulated from the latest round of tariffs. On top of that, some of Europe's heavyweights have looked to get ahead of any potential further headwinds, having already announced a swath of investments in America in coming years. AstraZeneca, Roche and Novartis have all committed to major investments over the next 4 to 5 years. Analysts at JP Morgan say large-cap biopharma companies should largely be able to avoid the new tariff, given that most of them have already started to increase their American presence, while inventory builds should result in little to no exposure until the middle of next year. Throughout the most recent earnings season, we've been asking pharma executives how they were planning to handle potential US tariffs.
We have 13 manufacturing sites already in the United States. And we have some free capacity because of the innovation that we've done in our processes. We've done all we can, and we are well prepared for anything that may come our way.
When we talk about GLP-1s, which is the active ingredient in Ozempic and Wegovy, we are actually exporting more from the US than we're importing in terms of volumes. So the trade balance, if you can call it that, is actually in a rather good place.
There's more clarity around where things will go in the coming years, and thus we can set up our supply chains. We can set up our operations accordingly to the new, to how the world is as we know it today.
Well, here we are kicking off the morning again talking about tariffs and sector tariffs coming into play here. The market, don't forget, had been largely trying to move forward, still looking at the lingering impact to hit on CPI numbers and what constraints that would bring to the US economy, but largely focused on the BBB, the big beautiful bill, and tax changes, deregulation, real positive catalysts to the market. But I think we circle now right back to where we started, looking at these sector tariffs. We've got Juliana on deck this morning, of course, and we're going to kick this around between us. Juliana, I think you'll have a lot to say on the pharmaceutical impact here. To me, if you've broken ground, if you've started building, then you'll be somewhat protected from these measures. Maybe there'll be some sort of tailwind too competitively from some of those European players that have been on the front foot. But for me, just putting all the other pieces of the puzzle in, I mean, Trump has thrown effectively the kitchen sink at manufacturers globally this year. Now he's actually throwing the kitchen cabinet too. So we're putting in their big ticket items, and this impacts Americans, even if it's not directly here in Europe. The fact that you've got these big ticket build outs from vanities in the United States to kitchens. So anything you're going to use when you're refurbishing a house, that's in the mix. On top of this week, we saw fresh security probes into wind turbines, airplanes, semiconductors, silicon, copper, timber, lumber, some of the areas that the US market has already been looking at, and now new probes this week into personal protective equipment, medical items, robotics, industrial machinery. I know we're throwing a lot at the screen this morning, Juliana, but that is the reality that investors are now dealing with in terms of tariffs.
You know, Karen, I think when you look at markets and you see that equities have moved from record high to record high, investors had taken the view that perhaps peak tariff uncertainty was behind us. And I think this is just a reminder that we could still be facing a very uncertain environment and more tariffs to come. Interesting, the rationale that President Trump seems to be using for these new levies on the likes of kitchen, bathroom cabinets, upholstered furniture, basically national security, saying the reason for this is the large-scale flooding of these products into the United States. He has looked at them as a matter of national security. Make of that what you will. On the pharma front, Karen, it's really a funny one because as you said, the European pharma giants, the most dominant players arguably in the entire healthcare sector, are already huge investors in the United States. They were before the tariff situation came to the fore, and even more so now. We've seen enormous commitments from the European pharma giants in the last 6 months. So they are likely to be exempt from these new tariffs. We also have the EU saying that they have agreed with the U.S. that levies on pharma goods would not exceed 15%. So the European pharma companies don't seem like they're going to be impacted by these new levies. Then when it comes to Japan, this is where we've seen the market reaction so far. We've seen a sell-off in some of the Japanese pharma names overnight because there's a lot of uncertainty around how these pharma products will be treated. You've got Tokyo's chief trade negotiator insisting that the U.S. gave Japan favored nation status when it comes to the pharma sector, meaning they wouldn't see levies higher than those imposed on other nations. So if you've got the EU sitting there with a 15% levy, a cap on pharma products, does that mean that Japan will also simply see a 15% cap on these tariffs, or are they subject to these new tariffs? One other thing, Karen, to throw into the mix on the pharma front, 9 out of 10 prescriptions in the U.S., according to one pharmaceutical body, are generic drugs. So those are not impacted by these tariffs at all. This is all about branded, patented drugs. And the majority of innovative medicines that are used in the U.S. are already made in the United States. So these pharma tariffs, I'm not sure how impactful they're going to be.
That is always the way with tariffs. It's devil in the detail from what we've seen in recent months as we've been clued up on the ins and outs here around some of these tariffs. But to me, what we're seeing on the sector side is a lot of domestic politics at play, and namely when it comes to the furniture side. If you look at it by numbers, Trump recently had promised to bring these furniture tariffs, saying will bring furniture business back to North Carolina, South Carolina and Michigan, of course, Michigan being a swing state. By numbers, the furniture and wood products manufacturing in the state has halved since the turn of the century. So that's quite significant, pulling lower in terms of domestic manufacturing capacity. But what was curious too is some of the infighting on what tariff impacts could have from here. And, I highlighted at the start, we're still looking for some inflationary pressure. There is a view that if there are higher tariffs on commercial vehicles, that could drive up transportation costs in the United States. And in fact, the U.S. Chamber of Commerce was urging the department not to impose new truck tariffs for that reason. A lot of the players already are also allies of the United States, close partners of the U.S. So that is, again, another feature as we talk about in recent days. And we've had a lot of clarity from central bankers and from economists saying, look, it could be a one-time hit in terms of the tariffs. In fact, you and I heard that this week around the set. But now we're, again, not talking about one-time impacts. We're talking about staggered across the board when it comes to sectorial impact on the inflation picture, Juliana.
And what does that do to the psyche of investors here? This trickle that we're seeing come through of tariffs. If you thought we were in the clear, then this news over the last 24 hours suggests we're not in the clear. And obviously, these are specific sector tariffs. It's not going to affect one's entire portfolio, but it certainly will have an impact on specific companies. And the threat of more tariffs like this on specific products certainly will be factored into the way investors think about investing in companies and think about the risk here moving forward. I think when it comes to the ultimate goal here from the Trump administration, when it comes to trying to bring manufacturing of upholstered furniture, of kitchen cabinets, of bathroom cabinets back to the United States, the question remains the same. Do Americans want to do the jobs required to bring manufacturing back? And to your point, what is this going to do to pricing? And what is this going to do to inflation? As you said, the prevailing view by the market seems to be, and by the Fed, seems to be that this is going to lead to a one-off, maybe staggered, given the staggered nature of these tariffs, but it's not going to lead to a sustained rise in prices, rather a one-off hit. But we'll see if that continues to be the prevailing narrative if we do see more tariffs like this come through.
Juliana, I'm going to take your water metaphor and run with it. I don't think it's a trickle. I think it's more flash floods in various sectors that is happening right now. And we heard from one central banker this morning, from the ECB, in fact, talking about in this uncertain environment, it means, in fact, they may do nothing. Not that they cut more, that they just simply stay on hold and wait it out. So it begs the question, has Trump just killed his own hopes for another rate cut in the short term? I mean, is that the death knell for that rate reduction that he's been demanding with a megaphone from the White House? Juliana, we'll get back out to you later on to hear all about the private equity news story as well. But in the meantime, let's get up to speed with markets with Ritika this morning. Good morning, Ritika.
Good morning, Karen. Yeah, let's start off over in the US, where we had a down session really across the board, though just fractional moves lower. You could see the S&P 500 was off 0.5%, the same move for that tech-heavy NASDAQ. But the S&P 500 has been down for 3 straight days. Its longest losing streak in a month. This is down to those fresh tariff announcements from President Donald Trump, everything from pharma to heavy trucks and furniture. This is adding to concerns in the market over lofty valuations. And this is after what has been an incredible rally for stocks this year, overshadowing somewhat of the more positive news on the data. For instance, that GDP print that we got out yesterday. Let's flip up the board and take a look at the Asian session, where we are seeing pressure across markets there. This is that you can see the Nikkei down some 0.8%, the Hang Seng Index down some 0.5%. Stocks really getting hit there on Trump's tariff announcements, those pharma stocks particularly in focus there. Let's see how the European market is shaping up. Seems like stocks there are bucking the trend, as you can see there across the board. FTSE futures up 0.2%, and the CAC up some 0.3%. So just eking out gains, but we are still having a down week across the board for European stocks. We have seen the US formally announce or go implement that trade deal with the EU, where we had that 15% tariff across the board, but some key exemptions like on that pharma industry. Finally, let's see how Wall Street is shaping up after yesterday's session. Actually going into the positive now. We can see S&P minis up 0.1% there after yesterday's session, but investors are going to be watching that PCE data. That is the Fed's preferred inflation gauge for any clues on the Fed and what its decision on interest rates may be going forward. Karen.
Thank you very much for that. Well, let's get into the data. It was a real mix yesterday, wasn't it? The US economy expanded by more than previously expected in the second quarter. Revised data showed notching the fastest pace of growth in almost 2 years. The final estimate was revised upwards by 0.5 percentage point to 3.8%, boosted by an increase in consumer spending. So somewhat of a tailwind coming through on the growth rate. Contrast that, US initial jobless claims fell to 218,000 for the week ending September 20th, the lowest level since July. The drop was more than economists had expected and comes despite concerns, including from the Federal Reserve, about US labour market weakness. So again, we look at these moving factors and whether that is the right condition for rate reduction. Speaking to our US colleagues, Citadel founder and CEO Ken Griffin gave his take on the state of the US economy.
If we came into the start of this year, people were optimistic about the stock market. I think there's been some unexpected policy volatility that has certainly made this a bit more of a roller coaster. But for corporate America, the weaker dollar is a real tailwind in terms of driving profitability. And then there is across the entire economy a real surge in business investment taking place right now in artificial intelligence and other areas in the technology space. That is helping to propel growth. We saw it in today's GDP number. Between consumer strength and business investment in the future, the American economy is doing pretty well right this minute.
And a final piece of data, the jobless claims the data comes ahead of today's PCE print, which is the Fed's preferred inflation gauge. On a monthly basis, the index is forecast to have risen by 0.3% in August, marginally higher than July. Dow Jones forecasts a 2.7% rise on an annual basis for the month, again a slight increase from the previous month. Ahead on the show, we'll discuss how geopolitics is weighing on the luxury market amid the first ever sale of a Russian-sanctioned superyacht. Plus, President Trump signs an executive order approving the sale of TikTok's US business from its Chinese owner ByteDance. And the US National Football League takes over Dublin. We'll be live with more on what it means for the league's global ambitions. We're closely watching energy stocks stateside after the sector topped the S&P 500 yesterday, gaining almost 1% despite most other sectors closing in the red. The S&P's energy index has gained almost 4% this week, with major players such as EQT and Baker Hughes also posting strong performances. Largely buoying the sector's run-up is rising oil prices, with increasing geopolitical tensions and supply concerns driving oil higher. Crude is heading for its biggest weekly gain in over 3 months as US President Donald Trump ramps up pressure on buyers of Russian oil alongside Ukraine's targeting of Moscow's energy infrastructure. Our next guest says that geopolitics plays a significant role in the luxury asset market. Joining us now is Anders Curtin, who is the CEO of Fraser Yachts, who is currently representing the first ever sale of a Russian-sanctioned superyacht. Anders, thank you so much for joining us. This is a fascinating turn of events. I think most of our audience were well and truly familiar with the freezing of Russian assets. And it was, of course, these very high-priced assets on the high seas that were in focus. The one we're talking about here, the Amadeira, I believe, is the one that could be coming to market. What is the ready buyer for a Russian asset when the optics may be a little bit negative?
Well, look, first of all, I have to start by stating that discretion is a really big part of what we do, considering the clientele that we have. So we're not really at liberty to discuss it particularly widely. And I don't really see a huge difference between this particular yacht or other similar ones in the market. It's the lifestyle that attracts buyers to these. And this is really the epitome of being able to choose your own luxury resort that you can move and wake up every morning in a new epic destination if you so will.
Indeed, with your own spa, gym and heli deck as well that comes with the yachts. Let me ask though about the pipeline that could be coming from some of these frozen assets. Is it just a one-off? We've got this one yacht coming to market, or do you think there's going to be a trickle of these yachts coming into the mix and that impacts the overall supply? How do you see that backdrop?
Well, I think, first of all, it's important to understand that this market, if we talk about it, we're talking about hundreds of sales on an annual basis, even if we look at all the global brokerage sales of yachts over 30 meters. So looking at sort of any sub-segment of that market, you're getting really down to very, very low numbers. So if we look at the sort of big yachts over 80 meters, even excluding where these yachts come to market from, we're talking about a very, very small number of transactions annually, if you look back over recent years.
Anders, I spent a lot of time in your part of the world over summer, and for anyone who hasn't been there recently, the area is absolutely booming, and there are yachts parked in just about every harbour they can find a place to moor. What does that mean in terms of fresh supply coming to the market, the second-hand market? What are you seeing in terms of appetite to soak up some of the existing stock versus buying new yachts that are coming to market?
There's about 7,000 yachts in the global superyacht fleet for the moment, and roughly 1,800 of them are for sale at this very moment. So I would think the inventory supply level is actually quite good for now. And if we look back at our sector for the brokerage, which is sort of fee-owned sales, if we compare 25 to 24 year to date, we've actually seen a pretty healthy growth of about 5%, both in number of units as in transactions and also in the dollar and euro value of those transactions. So we've seen a pretty good growth, even despite the uncertainty that we have going on in the world right now. So there is still a healthy appetite for the lifestyle that yachting offers.
Anders, I wanted to get into the pricing because we kicked off the show talking about tariffs, sector-specific tariffs, and even when it comes to yachts, I mean, 10% on EU builds, up to 245% on Chinese yachts. Is there a sense in coming years that pricing could be impacted by some of the US tariffs?
Perhaps for some of the sort of smaller end of the scale, but I think in the super yacht sector, you will not often see one of these bigger yachts being flagged, whether it's the American flag or the French flag or any European country's flag. So it doesn't really directly affect that in that sense.
You mentioned the American flag. What are we seeing in terms of buyers? Because we know there are very challenging parts of the world now. Russia, in terms of moving assets around, China has been a very difficult market, difficult economy for a number of years. When it comes to the high net worth and who's buying a yacht like this, where would you say the dominance is coming from in terms of a country-specific buying?
Oh, Americans are the largest group. They're number one for sure, then followed by Europe, and that's probably about 75% of the market. And then the rest is spread sort of evenly over the remaining globe.
The other big question that comes to mind is around the geopolitics, because the idea of, as you mentioned, hopping on a yacht and waking up somewhere else the next day, some of the safe passages have been impacted by geopolitics, namely, of course, the war in Ukraine and some of the instability in the Middle East. How is that impacting safe harbours and where these yachts are willing to sail at this stage? Obviously, insurance gets impacted as well. How are the geopolitics coming into the yacht market?
Well, if we look at the sort of traditional transitory patterns of a super yacht, whether we look at the charter side or owner-run yachts, an overwhelming majority is still the Western Mediterranean, and then perhaps for the winter season, followed by the Caribbean and the Bahamas. So even the traditionally migratory routes of these yachts don't really tend to go close to the hotspots. We do have an emerging destination in the Red Sea, which in the long run we do see will complement the Mediterranean season quite nicely. But generally, for me, for super yachting to really thrive, you need a couple of things. You need history, you need culture, you need destinations, and you need infrastructure. And these usually take a minute to develop in these emerging areas, even disregarding geopolitics.
Anders, help us out with the asset price and how to think about it, because I gather there's some bifurcation of the market. The very high end holding up very well, the slightly lower end of the yacht market a little bit impacted by the economies that we're seeing, impacted by some of the uncertainty. But if you are buying a yacht today, how do you think about buying something that will retain the best store of value?
Well, first of all, what I usually say is that this is an investment, but it's an investment where the return is primarily emotional. So let's start by that assumption. Then the second thing that actually is really interesting, if we delve into the statistics comparing 24 to 25, is that we've seen a really healthy rebound on the brokerage side in the 24 to 30 meters and 30 to 40 meters, which we would consider the smaller end of the super yacht spectrum.
And just finally, let me ask you about the actual purchase. How much is being done on finance versus just straight out cash purchases? And does the interest rate environment make any difference in this context?
This is generally something that we don't necessarily always have full visibility into. Quite a substantial part are financed in some way. And I think really the only impact that we've seen over the last 2 years is that perhaps we sense that the transactions may take a little longer time to come to fruition, to actually close than during the pandemic years or the pre-pandemic years. So I don't see a huge impact there.